to the Valuation Master Class Show. What I'm going to get you today, the takeaways are, first, you're going to learn my FVMR framework to evaluate any investment. Number two, you're going to gain a clear view of global valuations. And number three, you're going to discover how developed markets differ massively in value from emerging markets. Now, I'm going to be presenting a little bits of my valuation guide that I have. And if you're interested in that, just email me at me@andrewstotz.com and I'll share that with you. So now let's go into this for a moment, and I want to welcome you here. And if you have any questions, feel free to ask them in the chat. I'll do my best to answer them. In the Valuation Masterclass Show, I'm trying to help you become a valuation expert in months, not years. That's what we do in the Valuation Masterclass Bootcamp. But before I get started, I just had a conversation and I was asked a question. This is the second time I was asked this question. Why have IPOs in Thailand done so poorly recently? And I was asked it by a government-related person and a non-government-related person recently. And my answer to that is what's probably happening is that companies that are listing are putting pressure on investment banks, and investment banks are putting pressure on analysts to up their valuations. And so what's happening is that analysts are standing behind a valuation that's too high for that particular company. And as a result of that, what's happening is when those companies list in the market, the share prices fall. So one of my answers to that is we need to help analysts make sure that they're independent in their research and their work. That's not a topic for today, but it was just interesting to be asked that question twice. So here I am just sitting around, and I've got some great charts and slides for you to understand a little bit more about valuation. So let's get started, and I want to bring up the first one. Now, my methodology, FVMR, stands for fundamentals, valuation, momentum, and risk. And the first one I want to look at is fundamentals. Here we can see that I've calculated the EBITDA margin. Now I'm using an average from 2003 to 2005. So if valuations are a little bit high right now, then that's going to be averaged out to some extent. My purpose in this work today is not to talk about what's the latest valuation, but what's the average valuation over the last 3 years. I'm also not using forecasted valuation because I know I did my PhD dissertation on that, and I know that it's not a particularly reliable guide. So here we can see that the EBITDA margin of the developed world, the developed economies, is about 20.8%, very high, very strong. And in the emerging world, it's at 18%. What we can see is a pretty significant 2.5% gap in this core measure of profitability. So before we look at valuation, we have to understand the fundamentals. Then we'll look at valuation. Now, the momentum is all about earnings momentum and price momentum that helps us think about whether this valuation and these fundamentals can be sustained. So let's continue on with a look at fundamentals. The next fundamental we're going to go to is the net margin. And this is the bottom line. And we can see that net margin is 11.4% for developed world companies, and it's 7.7% for emerging world companies. That's almost a 4 percentage point difference, with developed markets being much, much higher in their profitability. Now, somebody asked me, emerging markets are down so much. When should we start investing in emerging markets? Well, the key to that is not the valuation, it's the fundamentals. And we're going to look at the momentum factor of whether those fundamentals are getting worse or getting better. And from that, we'll get a picture of that. But until emerging market countries get higher returns, they're not going to get higher valuations. Now, it may be that investors, let's say around the world, believe that the momentum in profitability for emerging markets is going to rise. And then we may see capital inflows into these emerging markets as a result of that. But I would argue that we could be a ways away. And if some people have asked if the U.S. profitability or if the U.S. valuation falls, would that send money into emerging markets? No, because when the US starts to fall, then that means risk globally is high. And people tend not to go to emerging markets in that case. So it's a little bit of a quandary, I would say. So that's the second measure. I want to look at the final measure of fundamentals to understand the difference between these two. And here we can see that we're going to look at ROE, return on equity. And developed market return on equity is 16.4 versus emerging markets at 12.2. So again, this case, a 4% higher level of return on equity. So why are emerging markets doing worse? Well, right now, their return on equity is much lower. Now, that also brings you to a question of, is that something that will always be? Has it always been? Well, no, there has been times that emerging markets have been very profitable. But part of what makes the US in particular, which is a heavy force in that developed market context, part of what makes it attractive is that the US is highly profitable. And it's hard to beat that. You know, I was just talking to someone about the Thai market, which is the profitability is very low. Now, the PE is quite high for Thailand, given that profitability is low. And I would argue that we're going to see later in some of the other markets that it's usually a case that it's just that earnings are falling faster than price. And so PE actually is too high in Thailand. Now, if you look at price to book for Thailand, it gets closer to being more realistic, but PE is one measure. So let's now look at valuation, because that's the focus of what we want to talk about today. Is, are stocks cheap? Are they expensive? Now, I'm not going to get down in this discussion down into the detail of specific companies. I think tomorrow I'm going to talk a little bit about companies and valuation. But for right now, let me remind you, by the way, that if you want to get this valuation guide that I'm showing you, just email me at me@andrewstotz.com, and then I'll send it to you. So now let's look at the next slide, which is related to valuation. Here we can see this is price to sales. So at the top of the P&L, developed market is much more expensive than emerging markets. We can see basically twice as expensive as emerging markets. Incredible. And that's the differential in valuation between developed and emerging markets, which is a lot of what I'm talking about today when we're looking at valuation. Let's go back to that. And then what we can see is that the middle bar is the world. And you can see that the world is much closer to the developed world. And that's because mainly the world has huge weighting. The world index has basically 60% weighting in US stocks. All right, so that is the top of the P&L, price to sales. What about the mid of the P&L? What about the earnings? Price is one thing, revenue is one thing, but let's look at price relative to some sort of earnings. What about operating earnings? Here we can see price to EBITDA, and let's call EBITDA operating earnings. And what we can see is that developed markets are equally more expensive than emerging markets with this measure. So again, we're basically, developed markets are at 13 times price to EBITDA, and emerging markets are at 7 times. It's an incredible difference. And 12 times price to EBITDA is very high. Now, generally, when we talk about price to EBITDA, really what we want to be saying is EV to EBITDA. What's the enterprise value of the company relative to the cash flow, EBITDA, that's available to both to pay interest as well as to pay dividends. And the way I like to look at a company is that you look at the gross profit, then you go and look at SG&A, remove that, and now you get to EBIT, or operating profit. And then I like to think that there's 3 investors that you have to pay. Investor number 1, banks, or anybody that lends you money. You've got to pay interest. Number 2 is equity holders. You got to pay them a dividend that comes after that EBITDA. And then the third is the government. They're a secret, silent partner in your business that demands to be paid their tax rate that they set. And if you try to not pay them, they'll shut you down. So EBITDA is before that. So we can say that EBITDA is whatever's available from EBITDA is going to be split between those three, as well as interest costs and some other things. But interest costs, taxes, and dividends are the three things that a company has to pay out, basically. All right, let's look at the next one, which is now we're down at the PE multiple. And the PE multiple right now is at 16.5. And the differential between developed world PE of 23.8 and emerging world's PE of 16.5 is less. It's not like it's double. And this, I believe, and I haven't gone into detail, but I suspect, I know it's the case in Thailand, and Thailand is facing some of these same things, is that it's driven by earnings or losses at low earnings or losses at emerging market companies. And this basically tells you that on a PE basis, the price hasn't gone down as fast as the earnings. Now, that's a little scary to think about, because if you realize that the price hasn't gone down as much as the earnings have gone down, and therefore PEs have stayed high, then you could argue that maybe emerging markets aren't cheap enough. We still need another round, another down cycle to make them cheap. Now, if the developed markets like the US start to slow down, you could also see the same effect, that the earnings would slow faster than market prices come down in the market. And the end result is that you could have a situation where it's not emerging market PEs falling, it's developed market PEs rising as developed market countries end up producing less and less than expected earnings. So that's the reason why I'm always a little careful about PE, because whether it's a company or whether it's a country, what I see with the PE is that it can be that it ends up being too high because earnings have collapsed. It's very rare that it's too low, and that's happening because earnings are going up faster than price. All right, so now let's go and look at the next one. What is the next one? The next one is price to book. Now, I like price to book because it takes out that aspect of the volatility of latest earnings, because it's an accumulated earnings, it's retained earnings. And so that makes it a more stable measure. And we can see here the valuation is half in emerging markets, but ROE is 16% in developed markets and 12% in emerging markets. So right now, you're going to pay 3.9 times price to book for an ROE of 16%. And in the emerging world, you're going to pay 2 times price to book for an ROE of 12%. You can see there's not a linear relationship in those. But I think you can say that the valuation of emerging markets is pretty cheap, but until ROEs and margins start to turn, maybe it's going to remain cheap. And that brings us to the next point that I want to bring up, and that is the point related to momentum. But before I do that, remember, if you want to get the valuation guide that I'm showing you that I've created over the years, just send me an email at me@andrewstotz.com and I'll send that to you. All right, so now let's look at the next one, which is momentum, top line momentum, sales growth. And here is part of the big part of the story, right? The top line globally is growing at 3.2% over the period of 2023 to 2025. And what we can see is that in the developed world, that growth is about 3.3. But in the emerging world, it's only 2.5% average top line growth over the last 3 years. That's pretty tough times, really, when you think about it. That's very, very slow growth. The average revenue growth is about 6%. So revenue growth is pretty slow right now. Now, let's look at earnings growth. Now, here's where it gets interesting. This is momentum. This is earnings growing. And what we can see is that in the developed world, earnings growth is at 8.2%. And in the emerging world, it's at 10.4%. So you can see that's an average of 2023 to 2025. This is the chart that really helps you think about it. It helps you think about, are emerging markets starting to look more attractive? Well, if earnings are accelerating faster than revenue, that tells us that margins are widening. And if earnings And when you think about it, the margins in the net profit margin, as an example, in emerging markets has pretty much nowhere to go but up. But the net margin in US companies in particular, in developed countries in general, is pretty high, very high, maybe as high as it's been in a long, long time. And so they've got nowhere to go but down. And with the acceleration in earnings in emerging markets, it may not have a big impact initially, but the market doesn't invest on the impact, it invests on the differential or the change. And what we can see is that acceleration in EPS is what Asia needs. If it can sustain that for years, and I'm saying Asia, I'm really talking emerging markets. If it can sustain it for 3 to 5 years, then we've got a bull run. You got an opportunity to buy pretty good companies at good prices that are growing faster than companies in other developed countries. Okay, so let's go now. What I want to do in the next segment is I want to look at the valuation guide I have has a lot of countries in it, but I want to look at the top 5 developed markets in the world, because we have to admit that's where the majority of the market cap is. That's where the majority of the economy is in the world. So let's now take a look. This is the price to sales ratio of the top 5 developed markets: US, Japan, UK, France, Germany. Now let's look at the world is trading at 2.4 times price to sales, but America is trading at 3.5 times price to sales. It's the most expensive. Japan, UK, France, Germany, they're all trading at basically 1 to 1.5 times price to book. The one that's really awful is Germany. Germany is in, maybe you could say it's in serious decline. It used to be a leader, and now it is not seen as that, and therefore people aren't willing to pay a premium for German companies. Why is that? Well, part of it is they used to get cheap Russian gas, and you can say that the biggest loser of the Ukraine war, besides Ukraine, which obviously is the number 1 loser, the biggest loser is Germany, because Germany lost its cheap gas that it got from Russia. And so now without cheap gas, it's hard for Germany to stand out, because they have, higher wages, and they have pension schemes and things like that they just can't afford as much anymore. Now, what's also interesting is the US at 3.5 times price to sales, just incredible. Now, of course, you and I know, and the purpose of today is not to go into too much detail on that. We just need to understand the big picture. But we know that that's happening in the US mainly at, let's say, the top 5 to 7 companies. And if you were to remove those top 5 to 7 companies, you're going to see that price to sales goes down maybe to 3 times. But also return on equity will go down too. Let's continue on with valuation, because the whole purpose of today's show is to try to understand and answer the question, are valuation levels high? And what you can see is that in general, the answer is yes. But part of that answer is they're only high in the US. Another part of that answer is they're only high in the 10, let's say the 10 largest companies in the US. I didn't have time to pull together charts on that, but that may be something where we'll go into more detail later. But let's just now go down the P&L. That's price to sales. What about price to EBITDA? The average for the world is 12. Germany is half that. UK is half that. France is at 8. Japan's at 9. And US is 16.4. And here we can see that Japan on a price to EBITDA basis is actually doing better than how it was. Let's go back and look at price to sales. And with price to sales was 1.3. But if we go and look at price to EBITDA, Japan's beating all the other countries. And that's partially because their cash flow is rising. The cash generating ability of companies is rising. And you don't see that in the price to sales. Again, if we go back to the price to sales, let's do that now. And you can see that Japan actually comes out at 1.3 times price to sales, which is about in the middle of the other countries, UK, France, and Germany. But when we look at price to EBITDA, Japan comes out on top. And that's basically because a lot more of the sales or revenue is flowing through to the bottom line. So now we've looked at price to sales and we looked at price to EBITDA. Let's now look at price to earnings. And here it gets interesting. Globally, the price to earnings ratio is at 22.7, and the US is at a very large 28 times. Again, if we were to remove the largest companies, we probably would be just down at maybe 20, 22, 23. And what we can see is that Japan to Germany, let's say Japan, France, and Germany are each trading between 16 and 17 and a half times. And then finally, UK is low. And it's interesting that it's understandable, if we look at PE, as I said before, it's understandable that earnings could fall faster than price, and therefore PE could rise up. But it's not often the case where investors basically are pushing down the price faster than the EPS fall. And that's what's happening in UK. And the end result of that is that the market, basically investors have exited the market, pushed down the price, and maybe they're waiting for the next upcycle. My final chart for the day is looking at price to book. And here you can see that the price to book at 5.6 in the US is massive. 5.6 versus an average across the world of 3.5. And if we look at Japan to Germany, they're trading at 1.7 to 2.1. So I want to talk about this for just a moment. And what I want to do is answer the question, why is it that companies trade above book value? Now, if you recall on price to book, what price to book is doing is it's basically saying, what are your net tangible assets? Basically, we're saying, what are all your assets minus your liabilities? There's your equity. And what's the price relative to that? Now, the thing about accounting is that with accounting, of course, what's happening is that they're using historical cost basis in accounting. Generally, they're using that, unless it's for instance, if it's a high inflation country, sometimes they'll make an adjustment to that. But generally, you're going to say that the assets on the books are at historical price. So if a company was trading on 1 times price to book, you would say that you're getting the assets of the company only. All of the future growth of the company is free. Well, no market's going to give away that for free. And that's why price to book tends to be above 1. In this case, let's say over a long period of time, since before America got overly valued, you could say that the average price to book was about 1.5 to 2.5. Let's say that's the range. And that difference from 1 is basically based upon what people are valuing the future opportunities at. So that gives us our last picture. That's the price to book. And let's go back to what we said at the beginning of the show. So I said you're going to learn the FVMR framework to evaluate any investment, and I've taught you about fundamentals, valuation, momentum, and risk. The second one is you're going to gain a clear view of global valuations. And I think what you've seen is that valuations are relatively high, but it's driven by developed markets. Global emerging markets are still struggling on valuation, but you've also seen this idea of EPS. I think that, to me, that was one of the best charts out of this whole thing. The EPS growth showing the emerging world has a faster EPS growth than the developed world over the past 3 years. And the next one is discover how developed markets differ massively in value. And we went through that and looked at that differential. Basically, emerging markets are about 50% cheaper than developed markets. And remember, if you want to get this this valuation guide that I just walked you through, just send me a message at me@AndrewStotz. Now, I do think we may have some comments or questions. Let me just check. Let's see. All right. So Lee says, let's see. Lee said something. FVMR is fascinating. Momentum is very appealing to me. Once the market shows signs of participation, it can indicate an entry opportunity and help us avoid value traps. Exactly. And FVMR helps me as a fundamental analyst not get stuck into just the valuation. This is cheap. This is cheap. We should buy it. No, I'm looking at more than just that. So when people ask me, what do you think about technical analysis? And I always say, if technical can help us, then I like it. And technical can help us when we look at momentum and share price. So Lee's just waiting by the sideline, getting ready to deploy his vast wealth in emerging markets, maybe. Himani says, why prices haven't gone down as much as earnings? Is it because of bullish expectations or everybody's of everybody for emerging markets? Yeah, it's a good question. I think that, if you look at some countries like Thailand as an example, many emerging market countries have been facing declining situation for a while, and the markets have been negative. And the result of that negative market sentiment is that they end up basically falling over many years. But the share price may come down initially, but then it kind of drifts down. And one of the reasons is one of the sunk cost fallacies, where many people say, well, I bought it at 100 and it's now down to 70. I'm not going to sell it now. I'm going to wait till it goes back to 100. So you have a lot of participants that are hesitant to make a sale, because if they sell at a loss, they say, oh, I'm not going to get that back. Now, generally, I would say the sunk cost fallacy is not very productive in investing, because basically the beauty of investing is you've got, let's just take Vanguard, the Vanguard ETF, the widest one, the VT fund has 10,000 stocks in it from around the world. So I think we can use that as a guide and say there's 10,000 large and liquid stocks in the world. And so your one stock that's gone down from 100 to 70, you're just going to wait it out? You don't think that 9,999 stocks is not one that would go up faster than yours? Now, there are tax considerations in some cases and other things, but generally we need to think about today going forward. And let's see, last one, I think this come in. Hobby Fanatic says, which industries usually have low price to book ratios? I remember looking at Kia. Yeah, so cyclical industries tend to have low PEs because there's so much up and down. The second one that has low P&E is price PE and price to book is banks. Because the thing is that banks' book value is actually more like its market value. So remember that if a company has assets like land and a company has a factory, that's all booked at historic price. But for a bank, the main asset is the loans and the investments, like investments in government bonds. And basically those basically have to be marked to market. Particularly the bonds. And in the case of the bonds, basically, they're marked to market on a regular basis. And so when you look at the price to book value for banks, the assets tend to be more higher. They're compensating for the market value. So the market's not going to compensate additionally for that. And that's the same thing with loans, because banks basically have loans, so they have to kind of mark to market and provision to market, and that causes the value of the loan book to tend to be somewhat closer to market value. And the result is that the book value or the asset value of banks are closer to the market value. And that's Roman. Good to see you, Roman. Fantastic. Good question. Well, I want to thank everybody for coming on, and just a reminder again, if you want to get that cheat sheet, the valuation guide, just send me a message at Andrew Stotts and I'll send it to you. And I look forward to this each day because I got a lot of things that I want to share. And so the Valuation Master Class Show is me basically taking out a lot of different things that I've got in my head and also that are in my computer. I have tons of files and charts and graphs that I've developed and automated in some cases over the many, many years. And this is a chance for me to share them. And if you want to get a piece of that, again, just send me a message at Andrew Stotts. I want to thank you, everybody, for attending. And I look forward to tomorrow's show where I'm going to talk in more detail. I think I'll talk about some specific companies. But for right now, over and out. I'll see